Hello, everyone. Today I will present to you about capital structure theory. When it comes to business terms and conditions, the capital structure is one of the basic foundations in this field. It is defined as the equilibrium between the debt and a company's equity. Without a stable structure, the business will collapse. A business requires the most beneficial capital structure. So many capital structure theories are available to take as a reference. Amongst them, we will discuss the four most essential ones, which are net income theory, net operating income theory, Modigliani-Miller theory, and traditional theory. Let's move to net income theory. This theory was postulated by David Duran, who put forward the idea of increasing the proportion of debt in the overall capital structure. According to him, debt is a fund source because it has a lower interest rate, eliminating the risk factor and playing a significant role in deducting expenses for income tax. This theory is also called the fixed key theory. As per net income theory, higher use of debt capital will result in reduction of WACC. As a consequence, the value of the firm will be increased. The formula of value of firm equal to earning divide by WACC. Thus, as per net income theory, a firm will have maximum value at a point where WACC is minimum. Now let's talk about the net operating income theory altogether. As you know, net operating income, also known as irrelevant theory, it was also postulated by David Duran. Net operating income approach is the exact opposite of the net income approach. As per net operating income approach, the value of a firm is not dependent upon its capital structure. In addition, it depicts that company market value is not affected by changes in the capital structure. The overall cost of equity can remain fixed, no matter the proportion of debt. Net operating income approach is the exact opposite of the net income approach. As per net operating income approach, the value of a firm is not dependent upon its capital structure. UACC is always constant, and it depends on the business risk. When value of the firm is calculated using the overall cost of capital, the cost of debt, K, is constant, and corporate income taxes do not exist. As the cost of capital is constant, the proportion of debt will increase, while the cost of equity also increases. Additionally, there is no effect on total cost of capital, WACC. The next main point that you should know in capital structure is Modigliani-Miller theory. What is Modigliani-Miller? The Modigliani-Miller M&M theorem is a foundational principle in corporate finance, developed by economists Franco Modigliani and Merton Miller in 1958. It outlines the relationship between a company's capital structure, its valuation, and its cost of capital. The theorem is based on two propositions under specific assumptions, including no taxes, no bankruptcy costs, no transaction costs, and perfect market efficiency. In short, the Modigliani-Miller M&M theorem is widely used in finance because it provides a theoretical framework to understand how capital structure influences a company's value and helps companies make more informed strategic decisions. Let's move to Formula Proposition 1. A firm's value depends on its earnings before interest and taxes, not its capital structure. Formula: expected EBT, the firm's operating income or profit. WACC: the average cost of financing, debt, and equity. It shows that a firm's value depends on its profitability, EBIT, and the cost of capital, WACC. Higher EBIT or lower WACC increases the firm's value. Proposition 2. Identical firms with the same earnings should have the same market value. If not, arbitrage occurs to equalize the values. Example: Firm A, unleveraged, valued at $1,000, firm B, leveraged, Undervalued at $950,000 but has the same EBIT. Investors sell Firm A shares and buy Firm B's debt and equity. As this happens, Firm B's value rises to $1,000, correcting the difference. In a perfect market, capital structure doesn't affect firm value, and arbitrage ensures market efficiency. Let's move to the traditional approach to capital structure theory. This is a critical perspective in understanding how businesses balance their funding between debt and equity. The traditional approach strikes a balance between these extremes. It suggests there is an optimal capital structure where the mix of debt and equity minimizes the weighted average cost of capital, WACC, and maximizes the firm's value. Initially, adding debt lowers WACC since debt is cheaper due to tax advantages. However, excessive debt increases financial risks, raising both the cost of debt and equity, which eventually increases WACC and reduces the firm's value. The key takeaway? The traditional approach emphasizes finding the right balance of debt and equity to achieve stability, growth, and maximum value. Thank you for watching and listening.